Welcome back to Talk Tickers. This is the place where we stop pretending to care about the polished press releases.
Right.
We ignore the glossy slide decks with the stock photos of people shaking hands, and we actually look at the numbers that move the needle.
The real stuff.
We are here to strip away the PR fluff, get down to the raw data, and really figure out what management is actually signaling to the street. I'm your host, and I am joined, as always, by the voice of reason across the desk, ready to tear apart another earnings call.
It is good to be here.
Today, we are turning our attention to a really fascinating ticker, one that I think exemplifies the identity crisis a lot of regional banks are going through right now.
Oh, absolutely.
We are looking at INBK, First Internet Bancorp.
And identity crisis is probably the most charitable way to describe what is happening with INBK right now. I mean, this is a digital-first bank based in Indiana that is attempting one of the most difficult maneuvers in the financial sector. They're trying to pivot from a legacy lending model, think traditional leases, mortgages, small business loans, into a high-velocity, high-multiple fintech and banking as a service, or BOSS engine.
It's like trying to change a tire on a car while it's going 60 miles an hour down the highway.
It is effectively open heart surgery while running a marathon. It's incredibly difficult.
That is the perfect image for what we're looking at today. We have a stack of documents here, the Q4 2025 earnings transcript, the supplemental slide deck, the analyst notes, and the story emerging is just fascinating. It's a collision.
A total collision.
Between a legacy lending model that is frankly giving them a massive headache and this shiny, high-velocity fintech engine that they're trying to bolt onto the chassis.
And the market is completely confused. I mean, you just look at the reaction to this quarter's earnings call, and the market doesn't know whether to hug them or sell them.
So that is our mission today. We are going to strip away the PR fluff. We are going to ignore the glossy Best in Biz awards for a second, and we are going to figure out, is this a value trap with a serious credit problem?
Or is it a misunderstood tech company trading at a bank's valuation?
And the stakes are high here because the divergence between this stock and its peers is it's massive.
You have the sector rallying hard, and this stock, well, it's been left out in the cold. It's really something.
Let's start right there. Let's start with the vibe check. Tuesday morning, the numbers drop. What happens?
Confusion. Absolute confusion. Stock opens, it wobbles around, and then it settles down about 2%. 2.02% to be exact.
Okay, so it moved from around 22 and a quarter down to about 21.80.
Yeah, around there. Now, in a vacuum, a 2% drop isn't a catastrophe. It's a bad day, but not the end of the world.
But you have to zoom out. You can't look at it in a vacuum.
You absolutely have to zoom out. The regional banking ETF, the KRE, it has been on an absolute tear. It's up over 30% in the last year.
32%, I think I saw.
Yeah, a huge run.
Yeah.
INBK down 38% in that same period.
Wow, that's a 70-point spread.
It is a massive spread. That's not just a little underperformance. That is the market shouting from the rooftops that something is broken.
It's one thing to be flat when the market is flat. It's another thing entirely to be drilling down while your peers are shooting for the moon.
It's the market saying, I don't trust you yet. And, this quarter was supposed to be the trust us quarter. They actually beat earnings expectations.
They did. Okay, let's look at that snapshot. The headline, GAAP EPS came in at 60 cents. Adjusted was 64 cents.
Right. And the street, the consensus, was looking for 51 cents.
So in any normal universe, you beat by 13 cents, you get a nice big green candle on the chart. People are happy.
You think so? But the quality of the beat really matters. And if you dig into that 64 cents, a good chunk of it came from tax rate favorability and some expense timing. It wasn't purely an explosion of core revenue.
In fact, they missed on revenue.
They did. That's the other side of the coin. Adjusted revenue came in at $42.1 million versus a consensus of $43.5 million.
So you have this really awkward dynamic. Hey, we earn more profit per share than you thought, but we actually brought in less money from the business than you hoped.
Exactly. And for a growth story, which is what they claim to be, revenue misses are poisonous. They're just toxic for the multiple.
But you're saying even that isn't the real reason the stock dropped.
No. I mean, the revenue miss was a flesh wound. The real damage, the reason the stock is down 38% on the year, is the credit picture.
The ghost of lending past.
Precisely. It's this battle we are seeing playing out on their balance sheet. On the left hand, you have the future bank. That's the fintech, the banking as a service, the massive deposit growth. Super exciting. On the right hand, you have the legacy bank. Small business loans, mortgages, leases, and the legacy bank is currently setting money on fire.
We are going to do a full autopsy on that credit situation because the guidance they gave for 2026 was, well, sobering is a very polite word.
Shocking might be a better word. It really was.
But before we wade into that swamp, I want to steelman the bull case. I think it's important. Because if you just look at the credit losses, you miss the transformation that is happening underneath.
That's fair. There is a legitimate engine being built here.
And it starts with a massive transaction they executed with Blackstone.
This was the highlight of their strategic pivot. They sold approximately $850 million of single-tenant lease financing loans to Blackstone.
Okay, pause right there. Single-tenant lease financing. For the listener who isn't a credit underwriter, what exactly did they sell?
Think of it like this. You are a bank. You lend money to a developer to build a brand new Walgreens or a Taco Bell. That building has one tenant, a single, usually investment-grade tenant.
Right, so it's a very safe, stable loan because Walgreens is going to pay the rent for 20 years.
Exactly. But because it's so safe, the interest rate on that loan is really low, maybe 4%, maybe 5% on a good day.
Which was totally fine in 2021 when money was free.
It was great in 2021, but now money costs 5%. The Fed funds rate is up there. So you're holding this massive bag of loans yielding 4%, and you're paying your depositors 4.5% or 5% just to keep their money with you.
You're underwater on the spread. It's dead weight on the balance sheet.
It's completely dead weight. So they called up Blackstone.
And Blackstone has a different cost of capital. They're happy to own that kind of asset.
Right. They want safe, long-term yield. So INBK sold this $850 million portfolio. Now, doing that is painful in the short term.
Why is that?
Because you lose the revenue from those loans immediately. Poof, it's gone. That actually explains part of the revenue miss we just talked about.
But the flip side is capital flexibility.
Massive flexibility. The CEO, David Becker, he framed this perfectly on the call. By selling those assets, they shrink the balance sheet, they take the cash from the sale, and they immediately pay off their most expensive borrowings. So they shrink the bank, but they improve the margin.
It's addition by subtraction.
That's the perfect way to put it.
Yeah.
And it allows them to reload. They now have all this capital freed up to lend out at today's rates.
Ah, so instead of earning 4% on that Walgreens lease,
They can lend that money to a construction project at 7.5% or 8%. They're swapping out low-yielding assets for high-yielding assets. It's a very smart, if painful, move.
so that's the balance sheet restructuring. That's the defense. Now tell me about the offense, the fintech stuff.
Yeah.
Because every bank says they're investing in digital, but usually that just means they updated their iPhone app.
Right. Or they added Zelle.
This seems different.
This is completely different. This is banking as a service, or BOSS. They aren't just trying to get you to open a checking account with them. They are providing the essential plumbing for massive tech companies.
Okay, give me the numbers. Make it real.
The deposit growth is just startling. In 2025, their fintech partnerships generated $1.3 billion in new deposits.
1.3 billion.
And that is triple what they did the prior year. Triple. In a world where most regional banks are fighting tooth and nail just to keep deposits from walking out the door, INBK is flooding the zone with low-cost cash.
And what about the volume moving through the system?
They processed over $165 billion in payments volume. That is up 225% year over year.
165 billion. That is not a cute pilot project. That's not an experiment. That is institutional scale.
It's the real deal.
Who are they working with?
They named names on the call, which I think shows a lot of confidence. They mentioned Ramp.
Ramp is huge, the corporate card and spend management platform.
Right. If you are a startup or a mid-sized tech company, there's a good chance you use Ramp. Well, INBK is part of the infrastructure that makes that card work. They also mentioned Increase and a new partner coming online called Pool.
These sound like infrastructure players.
They are. They aren't just consumer apps. They are B2B financial engines. They're in the guts of the financial system.
So how does this actually make money for INBK? Is it just fee income or something else?
It's a mix, and it's actually really clever. They generated about $6.7 million in gross revenue from fintech this past quarter. That's a combination of interest income and fees. But the real magic is what they call the off-balance sheet sweep.
Okay, explain that mechanism. That sounds like jargon.
It is. but it's important. So banks have a limit on how much cash they can hold relative to their capital. It's a regulatory thing called the leverage ratio.
Right.
If Ramp suddenly sends INBK $500 million in new deposits tomorrow, INBK has a problem. They have too much cash and not enough capital backing it. Regulators get nervous.
A good problem to have, but still a problem.
A very good problem to have. So INBK acts as a traffic controller. They take that $500 million, they keep what they need to fund their own loans.
The new construction loans at 7%?
Exactly. And then they sweep the rest of it to a network of other banks who need the deposits.
So they're just sending the money away?
They send the liability away, the deposit itself, but they keep the customer relationship. And more importantly, they earn a fee spread for managing that flow of money.
Ah. So it turns a balance sheet burden into pure capital light fee income.
It is the holy grail of banking profitability if you can scale it. And they are scaling it.
So they have the cheap deposits, they have the tech stack, they have the Best in Biz awards for their small business platform. They mentioned they're using AI for underwriting and documentation. On paper, this sounds like a stock that should be trading at 20 times earnings.
It absolutely should be.
But it isn't. It's trading like a distressed asset. And that brings us to the but, the deep dive into the bear case, the credit hangover.
And this is where the rubber meets the road. I mean, you can have the best fintech plumbing in the world, but if you lend a bunch of money to businesses that are going bust, your earnings are going to get crushed. It's as simple as that.
Management was very specific on the call about where the pain is coming from. They kept using the word isolated.
Isolated is the most dangerous word in a banker's vocabulary. Whenever a CFO says credit issues are isolated, I immediately grab my red pen and start circling things.
It's like when a politician says, "I've been clear."
You know something's coming. They claim the problems are contained within two specific portfolios: the SBA Small Business Administration Lending Unit and the Franchise Finance Unit.
So not the whole bank. They're saying it's not in their mortgages, not in their CNI book, just these small business loans.
Correct, but just small business is a big deal when that was your bread and butter for 5 years. Nicole Lorch, the president, she used this really victorial analogy on the call. She called it the bathtub.
I visualized a very dirty bathtub when she said that. Not a good image.
It's apt, though. She said, we know how much water is in the tub. What she means by that is they've identified the bad loans. They think they have their arms around the problem.
Okay.
But the problem is the drain, which is charge-offs, actually taking the loss, is open. But the faucet new loans turning bad is also still running.
They can't empty the tub because new delinquency keeps pouring in.
Exactly. And this is where the vintage analysis comes in. This is crucial for understanding the next 12 months for this company.
Go on.
The bad loans aren't just random. They aren't from 2022 or from today. They're very specific to the late 2024 and early 2025 vintages.
Why that specific time period? What happened then?
Think about the macro environment back then. Late 2024, inflation was still sticky, rates were high, but there was still all this optimism that rates will come down soon. The Fed was going to pivot.
Right, the pivot was always just 3 months away.
It was always just around the corner. So a lot of small businesses borrowed money at high variable rates, assuming they could just refinance into a cheaper loan a few months down the road.
And then rates stayed high.
Rates stayed higher for longer. And now we are hitting the 12 to 18-month mark on those loans. In banking analytics, that is the death zone.
The death zone.
If a small business is going to fail, it usually happens between month 12 and month 18. That's when they burn through their initial cash buffer, the business plan doesn't pivot as expected, and they default on the loan.
So INBK is staring at a snake that has swallowed a pig. The pig is that 2024 vintage of loans, and it's currently passing through the digestive tract.
A perfect, if slightly gross, analogy. And passing that pig is going to be expensive. Which brings us to the provision for credit losses. This is the number that spooked the market.
The guidance was. It was heavy. For the full year 2026, they're guiding to a provision of $50 to $53 million.
Let's put that number in context. In this quarter, Q4 2025, they made about $5.3 million in net income. They're telling us, the market, that they need to set aside 10 times their quarterly profit over the next year just to cover bad debts.
That completely wipes out the growth narrative for the short term.
It suffocates it. It just strangles the whole story. And look at the cadence they guided to. They didn't just give a full year number.
No, they broke it down.
They said 17 to 19 million in Q1 and another 14 to 16 million in Q2. They are explicitly, in plain English, telling us the first half of 2026 is going to be ugly. It's going to be painful.
That explains the stock drop right there. Why would you buy the stock today at $21 when you know Q1 earnings are going to be weighed down by a $19 million provision anchor?
You wouldn't. You'd wait.
You might as well wait until July and see if they've actually cleaned things up.
That is exactly what the market is doing. It's a classic show me story. But there is one number buried in the supplemental deck that really made me wince. The ACL, the allowance for credit losses, on the unguaranteed portion of their SBA book.
So this is the slice of the small business loans that the government doesn't back and pass it. This is IMBK's own risk.
100% their risk. The reserve ratio on that specific slice of the portfolio is 7.34%.
7.34.
It is astronomical. A normal, well-run bank might have a reserve of maybe 1.5% or 2% on its loan book.
So they're reserving at 3 or 4 times the normal rate.
Exactly. Having a 7% reserve means you basically expect nearly $1 in $10 of that portfolio to have significant issues. It signals that the underlying performance of those businesses is very, very poor.
Okay, so we have established the pain. It's real, it's expensive, and it's going to last for at least 6 more months.
At least.
And this is the pivot. Management is still projecting growth. They aren't curling up in a ball and waiting for the storm to pass.
No, they are being surprisingly aggressive. They are guiding for 15 to 17% loan growth in 2026.
Which sounds absolutely insane given what we just discussed.
Yeah.
How can you grow 17% while you were simultaneously cleaning up a multi-million-dollar mess?
Because they are pivoting what they lend on. They're changing the mix. They're moving away from those operational small business loans, the ones based on a business plan and cash flow.
And moving towards
Asset-backed lending, hard assets. They mentioned construction, investor commercial real estate, and equipment finance. These are all loans secured by a physical thing, a building, a piece of land, a big yellow bulldozer. It's much safer.
And I assume the yields on these new loans are better.
Much better. They said on the call they are originating new loans at yields in the high 6 to low 7% range. Their current overall portfolio yield is around 5.7%. So every new dollar they lend lists the average. It's accretive to the margin.
This feeds directly into their net interest margin, their NIM story. They are projecting NIM to climb all the way to 2.75 to 2.80% by the end of 2026.
And if they hit that, if they actually hit 2.80%, that is the game changer. We are at 2.22% gap right now. Getting to 2.80% is a massive, massive jump in core profitability.
And that's where the Fintech engine that we talked about actually pays off.
That's so.
Because the Fintech engine provides the cheap fuel. It provides the low-cost deposits.
Exactly. If you can fund a 7% construction loan with 3% deposits you got from your partner ramp or increase, your spread is 4%. That is a wide, healthy, beautiful margin. Most other regional banks are funding 7% loans with 5% CDs they had to fight for.
So INBK has a structural advantage on their cost of funds.
A huge one. If they can stop the bleeding on the credit side, that's the big if.
Speaking of funding costs and CDs, they have a tailwind there too, don't they?
A significant one, yes. They have about $850 million in certificates of deposit maturing in the next 6 months.
And these were taken out when rates were higher.
These were locked in when rates were peaking. They're paying about 4.15% on them, on average. They can replace that funding today at around 3.65% or even lower if they use their Fintech deposits.
So that's automatic margin expansion. They don't have to do anything smart to get that lift.
They just have to wait for the calendar to turn. It's a guaranteed tailwind to their innate.
Okay, so the bull case is this. You wait 6 months, you let the bad SBA loans flush out of the system, you watch the NE expand towards 2.80% driven by new lending and cheaper deposits, and you ride the Fintech growth story.
That's the bull case in a nutshell.
But there was a curveball in the call, something that complicates the revenue picture a bit. The government shutdown.
Ah, yes. The macro intrusion. The federal government shutdown, brief as it was, stopped the SBA secondary market cold.
Right. Usually INBK originates these SBA loans and then they sell the government guaranteed part of those loans to investors to make a quick fee. It's called gain on sale.
It's instant revenue. It's great for the income statement. But because of the shutdown, they couldn't execute any sales in November and December. So they got stuck holding these loans on their balance sheet.
And they decided to just keep holding them.
Yeah, it's a strategic shift born of necessity. They plan to retain about $94 million more in SBA loans on their balance sheet this year instead of selling them.
Now that has to hurt the non-interest income line immediately.
It does. They guided their fee income down to 19 to 20 million for the year. That line item used to be closer to 30 million. So that's a $10 million headwind.
More short-term pain.
But it's for long-term gain. These are good, government-guaranteed, floating-rate loans. They yield prime plus a healthy spread. So by keeping them, INBK trades a one-time fee today for a predictable stream of interest income for the next 10 years.
It stabilizes the earnings, makes them higher quality.
It makes them less dependent on the fluctuating secondary market. It's a higher quality of earnings, even if the total number is a little bit lower this year. It's a prudent move.
Now, I want to get to the part of the transcript that really made my ears perk up. The absolute wild card, M&A.
This was so unexpected. Usually when an analyst asks the M&A question about selling the bank, the CEO gives the standard boilerplate.
We are focused on organic growth and maximizing shareholder value.
Blah, blah, blah. The usual script.
David Becker did not do that.
No. He was shockingly, almost alarmingly candid. He just came right out and admitted they were approached 3 or 4 times in just the last half of the year.
3 or 4 unsolicited approaches. That's not an accident. That implies real hunger on the buy side. Who's calling them?
He gave us some broad strokes. He mentioned international groups who are looking for a U.S. banking charter, a foothold in the U.S. market. And he also mentioned other domestic groups that need help with their own fintech and compliance operations.
Wait, that second group is really interesting. Why would another domestic bank want to buy INBK for compliance?
Because INBK has spent years and millions of dollars building a BSAMLET's Bank Secrecy Act, anti-money laundering compliance stack specifically to handle these high-volume fintech partners.
That's hard to build from scratch.
It's incredibly hard and expensive, and the regulators are all over it. So if you're a traditional bank and you want to get into the buy space, it might be cheaper and faster to just buy INBK's tech stack and their charter than to try and build it yourself and risk getting it wrong.
And Becker's final quote on the topic was, "We entertain all inquiries."
That is Wall Street code for, the bank is for sale, the for sale sign is on the lawn, make me an offer I can't refuse.
This really changes the whole investment calculus, doesn't it? You aren't just betting on an operational turnaround anymore.
No.
You are betting on a potential takeout.
It puts a floor under the valuation, or at least it should. Think about it. They just cleaned up the balance sheet with that Blackstone sale. They have a valuable, hard-to-replicate tech asset. If the stock stays beaten down here at $21, it becomes a very, very attractive snack for a larger predator.
So let's talk about that valuation. Is it actually cheap?
It's trading at a pretty significant discount to tangible book value.
Okay, so in simple terms, if you liquidated the bank today, you sold off all the loans, all the buildings, paid off all the debts, the cash left over for shareholders is worth more than the current stock price.
You're buying $1 for 90 cents, theoretically.
Theoretically. Assuming the credit losses don't eat that dollar first.
That's the risk. But relative to the sector, the gap is just glaring. As we said, the KRE ETF is up 32%. INBK is down 38%. If INBK just performed in line with its peers, not even outperforming, just being average, the stock would have to rise 50 or 60% from here just to catch up.
That is the catch-up trade.
But again, it's a show-me story. The market is cynical right now. Investors are looking at this and saying, I see your fancy fintech slides and I hear your growth story, but I also see your $53 million provision hole. Fill that hole, prove the credit issues are contained, and then we'll talk about a higher valuation.
It feels incredibly binary. Either they successfully navigate this credit crunch over the next 2 quarters and the stock absolutely rips higher.
Or the bathtub overflows, the credit problems are worse than they guided, and the stock goes to $15.
That is a fair assessment. It's very high risk, very high reward.
Absolutely.
Which brings us perfectly to our favorite segment. We've looked at the data, we've spun the narrative, now we enter the speculation zone.
I believe there's some theme music for this.
We have to remind everyone, we are 2 voices on a podcast. We are not your financial advisors. Please do not trade your kids' college fund based on this little skit. This is the hedge fund pitch.
Okay, lay it on me. What's the outrageous but plausible play?
I call this the kitchen sink M&A ARB.
Kitchen sink M&A ARB. It's catchy. Walk me through the setup.
The setup is that management has effectively kitchen sinked the guidance. They took every single piece of bad news they could find, the bad vintage loans, the government shutdown delays, the lost fee income, and they shoved it all into the first half of 2026.
They lowered the bar so low that they can't help but step over it later in the year.
Exactly. They guided to a massive $53 million provision because they know they're under the microscope. They want to be able to come out in Q3 and beat that number to show that the worst is over.
So step one of the trade is you have to survive Q1 and Q2. You have to buy the feel.
You buy the fear. Specifically, I'm looking at long INBK call spreads for January 2027.
2027, so you're giving yourself a lot of time.
A full year of runway. Because this is a second half of 2026 story, you need to be holding the options when the Q3 and Q4 earnings come out. That's the inflection point.
That's when the provisions are guided to drop off a cliff. The NIM is supposed to hit that 2.8% target.
And the market suddenly realizes, oh, wait, this thing actually prints money now that the credit issues are gone. The stock re-rates higher.
So that's the fundamental re-rate thesis. But you called it an M&A arb. What's the kicker?
The buyout. David Becker is a pragmatist. He's been doing this a long time. He sees the consolidation happening in the market. He's got a clean balance sheet post-Blackstone. He's got a tech asset that foreign banks and other U.S. banks desperately want. I think he spends 2026 dressing the bride up.
Cleaning up the credit.
Getting the NAM looking pretty.
And then sells the bank in early 2027.
So you wake up one morning, you check your phone, and you see the headline. INBK acquired at 40% premium to yesterday's close.
That's the dream scenario for this trade. You get paid on the fundamental turnaround or you get paid on the buyout. Multiple ways to win.
You are buying a distressed valuation on a company that is essentially a tech platform with a temporary and hopefully contained credit headache.
Okay, I have to say, it is outrageous.
It has to be.
It's outrageous because you are literally catching a falling knife. The bank just stood up in front of everyone and said, we are going to lose a lot of money on bad loans for the next 6 months.
Yeah.
Most rational investors run away from that headline.
But the best trades are always the ones that make you feel a little sick to your stomach when you put them on.
That is very true. If the credit box is truly bounded, that $53 million number is the absolute cap, then this stock is absurdly cheap right now. But, and it's a big but. If that provision number has to creep up to $65 million, if the recession gets worse and more small businesses fail, then your 2027 calls expire worthless.
That's the game we play.
It is indeed.
So to wrap this whole deep dive up, first, Internet Bancorp. A digital pioneer caught in a vintage credit trap from 2024.
They beat on earnings, they missed on revenue, and they absolutely terrified the street with their provision guidance for the next 6 months.
The pivot to fintech is real. That $165 billion in payments volume is undeniable proof of product market fit. But they have to survive the indigestion of that 2024 SBA vintage before they can really enjoy the feast.
Q1 and Q2 of 2026 are the crucible. They are everything for this stock. We need to see that provision number come in at or below guidance and then start to fall. If it does, the upside is significant.
And if it doesn't?
If it doesn't, about below.
We will be watching that provision line item like a hawk in May when they report again. Until then, keep your stops tight and your diligence deep. Thanks for joining us on this deep dive.
Stay safe out there, everyone.